David, thank you so much for joining us here at SuperReturn International. In this sort of environment, what we're looking at going forward now, what would you say are the challenges and the opportunities that lie ahead for the private debt area?
Sure. Well, the challenges, I think, would be the economy. Clearly, you've got some macro trends that are, the world's facing. So interest rates, inflation, supply chains. We're seeing it come through companies for sure. You're seeing whether it's a Target in the US reported weak numbers on the back of cost pressure and supply chain. We're seeing it throughout a lot of industries. So one of the things we're being more cautious. The outlook we think is mixed, is very cloudy. On the other hand, we are in our asset class top of the capital structure, senior secured for the most part, floating rate, and with AlbaCore, at least, we look at large cap companies. We think that part of the market is fairly protected against the factors, but we're definitely considering them over the next several years.
And also inflation in that mix as well, I guess, as one of those challenges.
Yes.
In terms of that sort of environment, the dislocation you're talking about, you have expressed that actually there's a lot of an opportunity in that, and historically this area does well in those situations.
Yeah, I think for our business, we're a hybrid manager, so private debt now has become an asset class, sort of like the Beatles. Like there's four Beatles, but they're all a bit different, and everyone likes different members of the band. And I think it's no different in private credit. It's really evolved into fairly diverse managers, all within what's called private credit, which is more about the fund structure, closed-end structure, than about what we're investing in. And so for our business, we would call ourselves a relative value manager, a hybrid manager, which means while we can do a primary private loan for a company, again, we focus on large cap, we can also just as well buy a security in the market that trades at 80 cents. And so one of the opportunities we're seeing today, if you just look at fund flows, funds are flowing out of public markets, whether it's equities, high yield, loan markets. Money's flowing into private credit, mostly primary private credit. And so we see a bit of a mismatch in capital where the opportunity is more, where there's more sellers, is more of the liquid market, senior secured positions where we can buy them at material discounts to par. And if we buy those positions correctly, we buy the right credits, we can make materially more than just coupon, because you're buying them, in some cases, 80 cents or 85 cents on the dollar. And our business historically has done better in periods like 2009, 2012, sovereign debt crisis, 2017, the oil market pullback, 2020, and 22 is no different, that if you're a hybrid manager and you do it well, that public market can offer some pretty good opportunities.
And that's what the key question people always want to ask you. It's what we saw on the panel you were on earlier. Where can that yield now be found? That's what your expertise is in.
Exactly. And again, I think on a primary private lending perspective, you're getting paid more. But again, mostly issuing at par or near par, you're getting 2 points of fees. We're looking at more opportunities where you can buy debt in the 80s, where there's two benefits. One is risk of the loss given default is lower. So if we go into a default environment, and defaults will go up from 1 to 3 or 4 or 5 or 6 or 7. If you get defaults, there's a recovery, which is a dollar price recovery. If your starting point is 80 versus 97, it's a better downside protection. But also the upside case can be also more attractive. Now the risk is something at 85 maybe is going to 60, not par, and so it's about picking and choosing the credits in the 80s that you think are going to survive and do well. And of course, it all comes down to whether it's private market lending or listed market equity, credit. It's about credit selection and picking winners and losers.
What you're describing here requires, a serious amount of expertise, knowledge in sectors and geographies. And there's been a lot of conversation around talent retention in this current environment. What are you doing about that, and how do you make sure you hang on to your best people at the moment?
That's a great question. I mean, so far we have done that. We're 60 people in London. It's a few things. We try to make AlbaCore a good place to work. What does that mean? We're a very diverse workforce. We definitely have considered inclusion on various committees, and people communicate differently. So part of diversity is also diverse ways of communicating. It's not always the loudest, most charismatic person who should have, hold the court and hold the conversation, but other quieter people you have to ask questions. So we try to have an environment where we're sensitive to different types of people. So that helps with our diversity, which we score very, very high. But also having people feel like they have some ownership. We are a boutique company. We're owned by the staff, by the partners. and we're quite inclusive in terms of upside for people with carry programs or longer term equity in the business. So it's about them feeling like they're included in the business, that their voices are heard, it's a good place to work, and also having success. We've had a successful business in terms of performance, and people want to be at a business where there's good performance as well. So those are the different factors we look at. There's obviously, we try to pay people competitively as well. It's important.
So as well as sort of performance and pay, as you've described there, do you see the best talent also starting to look for something where they feel they have a purpose to what they're investing into? Do you see that element coming in? Has that been accelerated by perhaps people looking at the social impact of something like COVID?
Yeah, I think so. There's definitely, look, our purpose at the end of the day, it's not our capital, it's the capital of pensioners, of, retirees. So we do think about, when we boil down our business, it is managing money for mostly retired people in North America, Far East, UK, people that have worked at companies for 20, 30 years. We're managing their pension pots. They might be workers at aerospace companies or school teachers or citizens. We have a lot of money from Canada. And so ultimately our purpose is to make their lives better, to perform for them. At the same time, we have a very strong ESG focus at AlbaCore. So we've done this actually going back to 2010. The team started, the origin of the business was in the Canada Pension Plan Investment Board. And back in 2010, we were practicing ESG and kind of ESG investing, where we considered many, many factors, not just return, but also other factors, as you mentioned. And I think that also resonates with our staff and resonates with our investors.
Going forward now, the next question you're always asked at things like this is gaze into your crystal ball and tell us what we're going to expect to be talking about in 12 months' time. What do you expect the sort of near to, sort of 12-month future to look like for your business now?
Look, I think it feels a bit more, and one of the advantages of doing this, I'm 53, so doing this for many, many decades is I've been through many, many cycles. This feels a lot more like 2008, which was an elevated default cycle. It was a classic business cycle. COVID, if your only crisis was COVID, you have a fake crisis, a pseudo crisis. If that's what you think crisis is, you don't understand loss and risk of loss, because default rates remained below 1% during 2020. We think they're going to go a lot higher. So I think if I look into the future, you're going to see more defaults, which means potentially more loss given default. Equities look expensive to me. If you look at equities, they're still above the level they were pre-COVID. So the Dow Jones is at 30,000. It was 27,000 in February 2020. It's still up 10% before COVID, which doesn't really make sense given the outlook now. So I think you have a very difficult environment for equities. You probably have credit defaults going up, spreads going wider, and more opportunities either for primary lending. You're going to get paid more, maybe for better structures and less leverage, and also for secondary opportunities. As money flows out of credit, you're going to see better opportunities to buy, and the best returns come right after periods of extreme stress. So right now, traditionally, whether it's 08 going to 09 or 1994 going into 95, you see a down year followed by a very strong up year. And so we're now in the down year, and everyone feels that it's down. They feel depressed and sad, and everything's every day the market's dropping. But those are traditionally followed by very strong performance in credit, and I think it's no different this period. But we're still in that down period, probably for a few quarters. It's going to be difficult.
David, as you said, you've been doing this a long time, so thank you so much for sharing your very valuable insights with us here. Thanks for joining me.
Thank you for having me. Thank you.